I want to show you how to put more money into your IUL policy than your annual premium budget allows. Most people think they're limited to whatever their premium amount is. For example, if your premium budget is $12,000 a year, you may think that's the ceiling. But in this video, I'll show you how to structure things so you could get $60,000 in your policy while only committing the same $12,000 premium. That may sound surprising at first. And when most people talk about max funding their IUL policies, they're referring to paying the maximum premium allowed by IRS guidelines without crossing the line that would turn the policy into a MEC, a modified endowment contract. If you want more background on MEC rules, I recommend you check out my video called What is Index Universal Life Insurance Explained? But today's conversation is different. I'm not just talking about paying the maximum premium. I'm going to walk you through how to fund your policy with more money than your annual premium budget. If you stay with me until the end, and you'll see how this one tool can change your financial future. Before we dive in, my name is Elridge. I'm an investor, a private money lender based in New Orleans. My partner and I lend over $2 million every year to real estate investors. The strategies I share come directly from real world investing and lending experience. If you're anything like me, you will appreciate this information because, in my opinion, this is some high level stuff. So I encourage you to grab a pen and paper to take notes as we go. The method I want to share with you today is called insurance arbitrage. And to be clear, I'm not talking about borrowing from your policy to create an arbitrage. That's a different strategy. What I'm going to show you requires 3 key ingredients: arbitrage itself, leverage, but specifically the right kind of leverage, accruing debt, paired with properly structured IUL policy and a down payment. First, I'll explain arbitrage, and then we'll cover accruing debt. And after that, I explain why a down payment is critical. And finally, I'll bring everything together so you can see how the numbers play out in real life. So, what is arbitrage? Arbitrage is simply taking advantage of the difference in the cost versus return. It's when you borrow or acquire something at one price and then benefit at a higher price somewhere else, capturing the spread between. At its core, it looks like this: borrowing at a low rate, invested at a high rate, keep the spread as profit. Let me give you a lending example since that's the world I operate in every day. Imagine you borrow $100,000 from the bank at 6% interest. That means you owe the bank $6,000 per year in interest payments. Now take that same $100,000 and lend it to a real estate investor at 12% interest. That earns you $12,000 per year. And here's the arbitrage. You pay the bank $6,000, you collect $12,000, your net profit is $6,000. The 6% spread, that is arbitrage. You didn't create money out of thin air, you simply used the difference between two markets, the bank's cost of capital and the investor's willingness to pay for the money, and you kept the difference. Now, let's look at the second piece, accruing debt. Accruing debt means the amount you owe grows over time because interest or fees are added to your balance. The key idea is that the debt is not sitting still, it's accumulating. Here are the main ways this happens. Interest charges. If you borrow money and don't pay it back right away, the lender adds interest each month. Compounding. When that interest gets added to your balance, the next month's interest is calculated on a bigger number, which makes the debt grow faster. Fees, late fees, penalties, or other charges can also be added to the balance, making the debt continue to build. Most people think of accruing debt as a negative thing, but in this strategy I'm about to show you, it becomes a powerful tool. If you are gaining any value in this video, like and subscribe to the channel, help us get to 5,000 subscribers. Now, why down payment is necessary? A down payment is important because it shifts risk. Let me give you a clear example using real estate. When you buy a house, the mortgage companies usually ask you to put some money down, maybe 3% or more. Why do they require that? To reduce their risk. Let's say you buy a home for $300,000, 3% down equals $9,000. Add closing costs, and let's say you put in about $15,000 total. The lender now has a mortgage of $291,000 while you have equity from your down payment. Now imagine a year later, you need to sell, but the best offer you get is $296,000. Who takes the loss? You do. That $15,000 you put in is now at risk, not the lender $291,000. By requiring a down payment, the lender reduces their risk and shifts it onto you, the borrower. Every good lender understands this principle, reduce their own risk by increasing the borrower's skin in the game. The same principle applies with structuring an insurance arbitrage strategy. Your down payment reduces the risk that comes with leverage and accruing debt. Now, let's bring it all together. Now that you understand arbitrage, accruing debt, and down payment, let's combine them into the strategy. The goal is to create positive leverage. If you borrow at 5% and earn 7%, that's positive leverage. If you borrow at 5% and earn 5%, that's neutral leverage. If you borrow at 5% and only earn 3%, that's negative leverage. In some situations, you could turn neutral or even negative leverage into positive leverage by using a down payment to reduce the lender's exposure and enhance your returns. How does strategy work in practice? Let's use some real numbers so you can see how this works. Suppose your IUL premium is $12,000 per year or $1,000 per month. That's your down payment. Instead of stopping at $12,000, you leverage an accruing loan of $48,000 at 5% interest. That gives you a total of $60,000 to fund your IUL on day one. Here's what happens. The loan accrues interest at 5%. That's about $200 per month. But you don't have to pay it monthly. It's accruing. Your IUL policy is growing at 8%. 8% of $60,000 is about $400 per month in growth. In other words, by using accruing debt, your policy begins compounding automatically at a faster rate than your debt is growing. Let's project this over 5 years. At the end of year one, your debt is at $50,455.77. Your cash value is at $64,970.97. At the end of year two, your debt is at $53,037.18. And your cash value is at $70,373.28. At the end of year three, your debt is at $55,750.67, and your cash value is at $76,214.22. At the end of year four, your debt is at $58,602.98. Your cash value is at $82,539.97. At the end of year five, your debt is at $61,601.22. Your cash value is at $89,390.74. At the end of year five, your cash value has grown by more than $29,000, while your debt has only increased by about $13,000. That's a net gain of around $15,000 simply by subtracting your funding with arbitrage and accruing debt. Compare this to just putting in $1,000 per month without leverage. After 5 years, that would have grown to about $17,194. By using insurance arbitrage, the same $12,000 annual premium produces a little over $11,000 more in growth in the same time frame, because you are earning 8% on $60,000 versus 8% on $12,000. Of course, markets fluctuate. I use 8% growth rate for illustration, but some years your policy may only credit 4% or even 0%. That's why a down payment is important. It provides a cushion against years where returns are lower. The bottom line is this: even with conservative assumptions, the insurance arbitrage strategy consistently outperforms simply paying your annual premium without leverage. By combining arbitrage, accruing debt, and the principle of the down payment, you can dramatically increase the efficiency of your IUL policy. This is not just theory. This is the same type of strategies banks and large corporations use through their own insurance structures. If this resonates with you and you want to go deeper, I invite you to join our free finance community. Inside, we teach strategies just like this one in more detail with step-by-step breakdowns that you can apply to your financial journey. If you found value here, make sure you subscribe to the channel so you don't miss future videos. And remember, the key to wealth is not just working hard, it is learning how to structure money so it works harder for you.